This is our seventh episode of our 12-part Foundations of Transition series. And today, what we're going to be covering is financial fluency and clarity. And we've got this broken down into five different, what we're calling equal signs or dangerous equal signs. Welcome back, everyone, to the Journey to an ESOP and Beyond podcast, where we seek to make all things related to employee stock ownership plans both accessible and understandable. I'm your co-host today, Jason Miller.
And I'm Makenzie Wirth.
We'd like to say happy birthday, America. So I don't think there's much more like being American than rebelling over taxes and then taking action. And so, to help you on your journey to an ESOP, this is our seventh episode of our 12-part Foundations of Transition series. And today, what we're going to be covering is financial fluency and clarity. And we've got this broken down into five different what we're calling equal signs or dangerous equal signs. And one concept is usually conflated with another one, and we're going to break those pieces apart in the context of uh, financial fluency, which is the next step from financial literacy, which we've addressed before with our guests from the Great Game of Business and earlier in our foundation series. So, with that, one of the questions that often comes up in almost every successful company is, and if things are so good and the company is growing, why do we have to be so careful with spending and hiring or distributions?
Yeah, I think that's a really good question. And I think it probably means that people are aware of numbers and they're being told numbers in terms of revenues and profits, but maybe they don't have the story or the full story behind the numbers.
And there's always a story, and there's always interpretation. But today isn't just about teaching people how to read financial statements and say, here's what this number is, but about helping people understand what those numbers actually mean.
Yeah, I think looking at financial literacy versus fluency is, um, they sound very similar, but I guess there is a bit of a distinguishment between the two, where financial literacy is being able to learn the language and learn the language of financial statements, whereas financial fluency is understanding the entire story and related consequences.
And that's why we're talking about these five dangerous equal signs. So, without further ado, I'll start with the first one. And I think this is a common misconception, just in general related to business, from those that aren't necessarily business minded, even to those of us that may be more business minded. And that is revenue equals success.
Yeah, and I think we often speak in terms of revenue when we're talking about companies. It's their $100 million company, $5 million company, whatever it is. We're always referring to revenue, but revenue just simply tells us that we sold something or
Hmm.
we sold, it may not be something, may not be a product, maybe it's a service. However, it doesn't tell us whether we collected the actual cash, assuming your accrual basis, um, that your margins are protected, or that your business has been strengthened by that revenue growth or revenue number.
So what you're telling me is that a company can actually grow, but become less healthy.
It could. It's definitely possible. Um, Maybe you discounted too heavily to win work. Maybe you have a lot of customer concentration. So maybe one customer represents a significant portion of your revenue. Or maybe you're growing faster than your people or your systems can support.
What came to mind is I was saying that in growing and becoming less healthy, it's like obesity for business, kind of stressing all of the systems more than not. Maybe eating the wrong things. Maybe there's something underlying, an underlying condition that tells a story that leads to growth without staying on par with health. No offense meant in any of that analogy, just the weird things that come to my head as we talk through. How does this relate to an ESOP company, do you think?
I think it's important that employees who are now in the mindset of being owners, if they get hooked on that revenue number and they're celebrating revenue growth, they shouldn't necessarily just always be celebrating it because it's bigger or it's higher. They should celebrate growth that is profitable and sustainable and makes the overall company stronger.
So revenue is more evidence of demand, which is a great thing to be in demand, but not necessarily evidence of health.
Right.
Now we get to a fun one that whenever there is a political conversation around taxes and business taxes and what companies should be paying taxes, and I'm only harping on taxes again because we're very close to July 4th, and I think it's fun. So this second equal sign is profit equals cash.
Mhm. I think this is a good one and can be probably confusing, but profit measures performance, whereas cash determined capacity. So you may have, especially if you're thinking accrual basis, which most of our clients are, you may have performed all the work and earned the revenue, but if your customers haven't paid yet, you don't have that cash. So just because you earn the revenue, that doesn't always equal your cash balance or your cash position and capacity.
That's probably, I say probably, I know it's a little more delicate and fragile with an ESOP company because you have other obligations to worry about than a traditional company. When we think about repurchase obligation or we think about the debt service on the acquisition indebtedness, and then still having to reinvest in the business so that it achieves its strategic objectives as a company. And a profitable year may be an indication of success, but it doesn't mean that there's excess cash available to satisfy all of those needs. So I guess instead of saying, trust us, the cash is complicated, leaders should often try to explain where the cash is actually going.
Yeah, I think the profit only tells part of the story, but the cash determines what the business can actually do.
Cash is king,
Cash is king.
right? Um, sorry, King George III. Um, we'll see how many of these we can fit in today as we go through. So our third equal sign is that this one is probably most important for owners, and that's valuation equals sale proceeds. So Mackenzie, unpack this one a little for us.
Yeah, this is definitely one that I think can be misconstrued, and it's even when we're working with our clients, educating them on how value is derived and calculated and what factors are considered from the P&L versus the balance sheet. Um, as you said, valuation does not necessarily directly equal the proceeds that you'll receive in a sale. The actual proceeds depend on other factors such as debt, taxes, the costs of the given transaction, the deal structure, and the timing of payments based on where that deal structure lands. So it is not as simple as the valuation is equal to the sale proceeds.
If only things could be simple. I would think, and as we're considering, or as you, listener, are considering becoming an employee-owned company in an ESOP, another question matters just as much, which is, can the company successfully support the transaction while continuing to invest and grow? And a financially responsible transition isn't just possible, but it should leave the company healthy afterward. And that kind of leads us to number four, which is when companies become employee owned, this is what commonly appears, and it's another misconception, is that share price equals employee wealth.
Yeah, I thought this was an interesting one. Um, of course, the goal is to increase the share value of the company, and that 100% matters and is important in rolling out the ESOP and continuing your communication of the ESOP. Um, but it shouldn't just be a one-time goal that the employees are working towards. They're not working towards a peak share price. It's more of a long-term benefit. So it's not only chasing or working towards a higher share price, but building a company that maintains that high share price and that maintains its value that you're reaching towards.
I like that perspective. And if the company thinks about long-term sustainability and uh, repeat ongoing, again, using the word sustainable growth, then it's a constant target for value, and it's not moving goalposts. So there's a subtle distinction between those. And we talk about this pretty often with clients around most of the things that or the context that you have around publicly traded stocks similarly apply to the stock of your company and the stock of an ESOP company. There's a market and there's a price and there are shares, and those shares are owned by the trust but allocated to the employees. We can talk about that at length as well. But the market doesn't report from 9:30 to 4 Eastern every day, second by second. And you don't have an opening and a closing share price to worry about when there's macro news. You have an annual share price that you contribute to and that the employees contribute to. And I think that helps not to worry about, oh no, we're in the red today, or we're in the green today, or in the black, I guess is a better way to look at it, in the black today. What's happening with our share price today that I can do tomorrow? So how do you think employees should think about share price and their wealth?
I think this goes back to previous episodes we've done, I think as part of the Foundations of Transition series, but the employee should understand how their role and their daily, I don't want to say daily task, but how they show up to work daily and how they execute their role contributes to building the long-term value of the company in terms of whether that's their productivity, their customer service, safety, quality of their work, being able to tie those two pieces together. So it's not just watching the number meaning the share price, grow, but it's influencing what creates that value.
That's a great point. And when we talk about this financial fluency, that's really what we're encouraging you to help instill in your workers is not here's EBITDA or here's a particular KPI, but we have the record of that. Now that we have the record, what's the meaning of this? How did it get here? Why is it higher or lower or sideways? And then it's what can we do to improve or maintain or correct what this means and asking those questions around the hows and the whys rather than what is just the meaning of this number. So our final dangerous equal sign is that transparency equals clarity. And I may have uh, preempted this one a little bit. Mackenzie, what do you think?
Yeah, I think sharing more numbers, having that open book policy doesn't automatically create an understanding. It can sometimes actually create more confusion.
So what does clarity look like?
I think it's important when you're sharing those numbers that you're kind of back to what we've said before, you're explaining the story behind those numbers. You're explaining what has changed, why it changed, what management and leadership is focused on, and then what decisions follow. I think it's also important um, when you're transparent with your financials, like there's probably a balance of how much do we share,
Hmm.
like not getting too into the details to create more confusion, but finding that happy medium of transparent enough that they can understand the story to help bring the whole picture together, but not giving too many details that it's overwhelming and confusing.
So what you're saying is that basically a giant data dump of the quarter end and year end financials is not necessarily the same as a communication strategy.
Right. You may not have a lot of financial statement readers if it's just dumped, maybe filed away.
So what does a company that is financially fluent look like? What kind of questions can they answer?
Yeah, I think a financially fluent leadership team within a company could answer questions like what is actually driving our performance? Where is the cash going? So if we're profitable or if the perception is that we're in this big growth period, um, what is consuming all of the cash? And then what decisions should follow? What decisions are being made and what decisions are thought about being made in the coming months?
I think this ties together a number of the things that we were talking about today, and that a company that is financially clear, has clarity around its financials, are able to kind of consistently explain what's changed, why it changed, what it means, and then I think the most important part for any company, but especially for an ESOP company, is what then can employees influence?
And I think it's important to note that the goal here isn't making everyone financial financially fluent or literate enough to then take on a CFO role or kind of like be at that level. I think it's just making sure people aren't making decisions based on rumors or incomplete information or assumptions from financials that are not explained.
I think that makes a lot of sense. Um, there's probably balance in that too, right? And how do you roll out such a strategy to be transparent to what degree, what level of the organization are you going to be transparent with the financials? Um, and how do you develop a plan to create the space to create that element of culture that allows them to become fluent at their particular level to that degree that you're willing to build that plan so that they can answer those questions. What changed? Why did it change? What does it mean? And then finally, what can I do about it to improve, again, maintain or correct? So as that leads us into this idea of transitioning your company to new ownership, specifically employee ownership. Um, every single transition creates promises. Promises to you as owners, promises to employees, promises to your customers, and also promises to future leaders. And that's going to look different for every company and also every transaction, whether it's an ESOP or not. You're you're saying something to yourself, your buyer is saying something to you. Um, you're likely trying to assure all the people that work for you that, hey, things are going to be as much as possible the same as they were before. And we talk about that often in the context of an ESOP transaction, is the company will be what it was the day before the transaction, the day after the transaction. And it's one of the great benefits of continuity that allows for this culture element to permeate. And then how does that impact your future leaders? And what promises, whether explicit or implicit, have you made to them in the past? What they should expect about their future. And everyone likes to say to their customers, regardless of change, hey, everything's going to be at least as good as it has always been, if not better. Because that's what businesses tell their clients when change is changes around.
And I think eventually all of these promises, even though with transitions and transactions, the change isn't overnight, it can take time. So eventually those promises have to meet reality, and specifically in our the context of our conversation, financial reality.
So you shouldn't be asking just whether the company is growing.
You may ask whether it's getting stronger, not just growing.
And then don't ask only whether it's profitable.
You can ask whether it has the capacity to keep its commitments.
And don't ask only what the business is worth.
You can ask instead what it will take to preserve that value for the next generation.
So financial fluency isn't about memorizing numbers. It's about understanding what those numbers require of us. And the strongest transitions aren't defined by the biggest valuation. They're defined by building a company that's strong enough to keep the promises that it made along the way to all the people it made those promises to. So on today, or during this week where we're celebrating America's 250th birthday, America is a promising country that has made a lot of promises to its people for liberty, right? And the pursuit of happiness. And we enjoy nothing more than helping clients like you achieve and exit a transition of your ownership in a way that honors all that you've brought to your company and its success. And we like doing that in a very tax efficient way in order for us to celebrate properly some of the instigations of what created our great country. So we thank you for listening to us and for joining us on our seventh of our 12 Foundations of Transition. And we will see you next time on the Journey to an ESOP and Beyond podcast. Thank you.
Thank you.